Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks pushing higher as investors price in rate cuts. What are the trades to play amid the rally? We'll discuss. And Cava shares are sinking amid a slowdown in consumer spending. We'll sit down with CEO Brett Schulman for more. And Amazon plans to expand its same-day grocery business, hitting Instacart, Kroger, and more. We'll discuss that and much more coming up on Market Catalysts. First, let's get a check of the markets here. Remember, the S&P 500 and the NASDAQ closed at records yesterday, so any gains today means more records for those averages. So we have these continuing hopes that the Fed will indeed cut rates in September. One of the things that is contributing to gains today, the Dow is leading gains up more than 350 points, about 0.8%. The S&P and the NASDAQ closer to 0.33% gains. And let's look at the bond market as well. Now, when we talk about what's being priced in terms of rate cuts, we're mostly talking about the interest rate futures market. The bond market has been a little up and down this week, even as futures have been pricing in that higher likelihood of a cut in September. But today, the bond market is also reflecting that view. We've got the 10-year yield down 4 basis points to 4.25%. The S&P 500 closing out its 16th record high this year with the risk-on rally showing not really any sign of letting up. Stock gains have been largely driven by the tech sector. Can that tech momentum, though, continue? Will we see a broadening out? I want to bring in Jay Jacobs, BlackRock U.S. head of equity ETFs, for this week's ETF report brought to you by Invesco QQQ. So, Jay, I know that you guys focus on sort of large, long-term themes and that AI falls squarely into that bucket. Nonetheless, if investors are investing in this theme, and from what we have seen of sort of technological waves in the past, sort of what does the cadence look like? In other words, we've obviously had crashes in the past sometimes when you have certain technologies being adopted. What do you think the cadence of this one's going to look like?
Well, this is very much a long-term theme. In the short term, the market is constantly trying to price in what is the value of artificial intelligence. Is it single-digit trillions of dollars? Is it double digits trillions of dollars? That still remains to be seen, but the reality is that we see this as having a tremendous amount of economic impact, akin to what we've seen with the rise of the internet, and we're still very much in the early stages, in this build-out phase where you're seeing tons and tons of CapEx to build out the data centers, build out the models, before we see the widespread enterprise adoption that will drive a lot of revenue in this space.
Well, and Jay, another interesting aspect of this is that we have seen, we keep talking about the broadening. Even within the AI trade, there's been broadening. We talked to Scott Kroner from Citi yesterday, and he pointed out that the rally, for example, we've seen in something like industrial stocks is really ties back to AI as well. Because so many different parts of the economy are being touched by this. So how should investors be thinking about where to go?
I think that's exactly right. I mean, look, we've seen a rally in some real estate stocks that are building the data centers. We're seeing a lot of enthusiasm amongst investors around utilities that are generating power because there's going to be so much power demand for artificial intelligence. So there's a very broad ecosystem. You can look at it from kind of a technology lens, but you can really look at it from a whole economy lens. One of the maybe lesser appreciated areas with AI is healthcare. Can you reduce costs and speed up the development of pharmaceuticals with artificial intelligence? Can you structure a lot more data from doctors around patients using artificial intelligence? So using this as a tool to make industries more efficient could be very beneficial to some of these stocks.
Do you think it's too early to get in on that kind of a theme? It's better to look at some of those other stocks. I mean, as you know, healthcare has been a pretty underperforming sector.
I don't think it's too early. Just investors need to expect that this is going to be a long-term play. I would not want people to be thinking about this as kind of a weekly or monthly trade. If you are buying the AI theme for its potential for disruption, this is a 10-year play. You can get in today, but you have to kind of watch the volatility and just sit back and look at the long term for this.
And speaking of the long term, I mean, we do have fits and starts, right? You've got something like a Coreweave pulling back today. You have the release of ChatGPT-5, which has seen its share of critics, right? So, as people watch those daily headlines, how should that affect their thinking? I mean, I understand keeping it long term, but shouldn't you also incorporate kind of what's going on, what the latest news flow is on it?
Well, I think one of the shifts that we want to keep our eye on is when do we go from this build phase where it's so much focus on capital expenditures and this infrastructure build out to more of the enterprise adoption stage. And maybe that's going to be from new large language models that are ever more powerful. Maybe it's going to be from new contracts with governments or major corporations that are adopting AI. But that's what we want to see. The progress is going to happen from the build out to the enterprise and government adoption. So when we look at some of our active strategies like BAI that's actively managing exposure to AI stocks, what we would expect is maybe some of a shift away from CapEx and more to the large language models and application users as you see that adoption happening.
Have you guys seen any slow inflows to any of these products, or is it just like up and away?
It is accelerated. What we've seen is billions of dollars come into our AI suite in the last couple of months, regularly seeing very significant inflows. It's happening both on the active side with BAI, more of the whole value chain with ARTI, which is our index-based AI ETF. Investors are recognizing that not only is this a hot theme, but they're not really getting good exposure to it through just the S&P 500 or through a tech sector ETF. They really need a dedicated allocation to capture the AI value chain.
So I'm glad you brought up that point because, all year, and not just this year, for a few years now, we've been talking about the concentration in the S&P 500 and that it is over-indexed to these plays. So why then do people not just buy the S&P and forget it? And why do they want to be even more concentrated?
Well, the Mag 7 is just a really narrow sliver of what the AI value chain is. Most of those companies are in the large language model space, and maybe one or two are kind of in the hardware semiconductor space. But when you look beyond that, we talked about the data centers, we talked about the power. There's a much wider range of semiconductor stocks that are going to be playing into the AI space. There's companies that are using AI to build new products and applications. So if you really think expansively across this tech stack, this is not about 7 companies. This is more like 30, maybe even up to 50 companies that are going to benefit. So you can really get much more diversified across AI and at the same time really kind of focus on this theme by selling the tech sector and buying an AI ETF.
At the same time, the implication is, if this is going to continue on as it has been, that it will help the broader market as well. Do you see any slowdown in this push to record highs as long as this AI trade is working?
AI can be a major tailwind for the entire economy, and there's a few reasons why. One, obviously, the U.S. has been an incredible tech innovator. Tech is a huge part of the S&P 500, so generally speaking, it could rise, a rising tide could lift most ships. The reason why I would say most ships, though, is that this isn't just one directional. There are companies that are going to be heavily impacted negatively by artificial intelligence. Their business models could be upended by AI. So,
do we know what they are yet?
Well, somewhat. I think one of the areas where it could kind of fall on either side of this coin is in software companies. Some software companies can get much more efficient and develop software more quickly with artificial intelligence. Other software companies could really be kind of disintermediated by AI because if you were licensing software from someone for a while and now you could build that software very quickly using your own large language model, why would you pay this company over here for it? So there's certain industries that I think is a little bit more up in the air kind of how it's going to play out. There's also industries that are very insulated from artificial intelligence. And these are some of the industries that we've really liked on some of our thematic rotation ETFs like Throw. Think about infrastructure names, construction names, some real estate names. Hard to see how AI is going to change those business models today when AI lives much more in the services world than in like construction, for example.
Right, IRL stuff that you can't get AI to do. An earth-moving machine is an earth-moving machine, I guess.
Well, and it's somewhat ironic because if we went back 10 years ago, the expectations were that robotics would be really the bleeding edge of artificial intelligence, that we could automate kind of lower-skilled physical jobs. The reality is it's the services jobs that have been much more augmented by artificial intelligence.
Right. Jay, good to see you. Thanks for coming in. Appreciate it. Coming up, what's for lunch? Mediterranean fast casual chain Cava posting comparable sales that missed the mark. We're going to speak to the CEO next. You're watching Market Catalysts. Shares of Cava are sinking after the company's same-store sales came in below estimates in the second quarter. The fast casual restaurant also cut its full-year sales growth forecast for the first time since going public as it navigates a, quote, fluid macroeconomic environment. Joining me now, Brett Schulman, Cava CEO, as well as Yahoo Finance senior reporter Brooke DePalmu, covers the consumer-facing names for us. Brett, thanks for being here. Appreciate it.
Thanks for having me.
So, I guess I have to ask, first of all, what this means, what this tells you about the consumer. Is the higher income consumer in particular weakening? And we should say your comps didn't fall. They were up by 2.1%, but that was worse than estimated. So what message is that telling you about consumer spending?
Yeah, for us to Cava specifically, it was a combination of factors. We did have very significant challenging year-over-year comparisons. We launched steak, which was our most meaningful protein launch in a number of years, last year in the same quarter. So that did create a more pronounced lap of the comp. And then we also saw that our 2024 new restaurant class, opened at record levels, and when they entered the comp base, they didn't contribute what they typically do, given that they had opened at such elevated levels to begin with. Now, having said that, we do see what I would classify as a macroeconomic fog around the consumer that they're trying to navigate through. And that has the consumer less front-footed, less ebullient, less forward-leaning than they were, say, this time last year. And as we see, whether it's the budget bill and getting clarity on that, whether you like what's in the bill or not, at least you have a sense of what the future is going to look like. But then when the tariff policy shifts, that creates a little bit more density in that fog. So just trying to make sure we're putting a great everyday value out there for our guests so to help them navigate this situation.
What you were talking about lapping, not just steak, but those first-year restaurants that showed really strong growth. What are you sort of trying to put in place then to keep momentum going at those new locations?
Yeah, we want to focus on the long term, and our new class is tracking toward $3 million plus average unit volumes, which is higher than our existing AUV, around 2.9 million. So super encouraged by the strength that shows in the portability around the country, whether that's Plantation in Florida or Pittsburgh we recently opened in Pennsylvania. And we want to be thoughtful about the long-term strength of this business. And so, for example, we have chicken shawarma launching in September. And we have a very good innovation cadence going forward, but we didn't want to rush chicken shawarma this year and perfectly align it to lap that steak comp from last year and potentially put too much pressure on operations. So excited to bring that in September. We've also got cinnamon and sugar pita chips coming later this year. And we also noted that we're testing salmon in our market test of our innovation process that you can see on our menu next year. So putting that consistent pulse of innovation from the culinary standpoint. And then we just continue to see these macro tailwinds for Mediterranean as a category, that unique cuisine where taste and health unites, the growing appreciation for it, as evidenced by when we open in all these markets around the country, the increasing AUVs we're seeing in elevated levels of the openings.
Now, you're in both urban and suburban markets, and particularly we got some new data out that showed that New York City office workers are returning to work compared to pre-COVID. It's now up. But yet you're experiencing a bit of a slowdown. So are people just packing their lunches more, perhaps?
Well, that's what is actually encouraging to us, the underlying structural strength of the business. We did not see any specific weakness in a region, a market, urban versus suburban, or even an income cohort. We stratify our restaurants by the average household income in these markets, and our lowest income markets are actually performing the best on comp. So the fleet of restaurants is moving in unison, and as we lap those very significant hurdles in June, we saw them decelerate, but as we exited the quarter, we saw the fleet start to regain momentum and reaccelerate into the third quarter.
I do want to dive into that a bit more, because what are you seeing in the beginning of these Q3? Is that fog that surrounded the consumer slowly moving behind them?
Well, it remains to be seen, with the shifting tariff policies, but we did note our comp has reaccelerated over our Q2 level in the beginning of Q3. So encouraged by what we're seeing in the exit rate of the quarter.
Will you ever return to that double-digit sales growth that we saw?
Well, we're always working to continue to drive traffic over the long term. Again, we want to build this for the next 10 years and beyond, not the next 10 weeks.
I do want to hit on tariffs and the impact that it's having on your company. What are you seeing now with the current system that's in place?
Yeah, I'm super proud. I want to give a shout out to our supply chain team. They've been incredibly agile this year, really working on behalf of our guests to mitigate any of those cost pressures we're seeing. And when you put all the puts and takes together and the things we've been able to do to drive efficiency and economies of scale and sourcing, we've actually been able to mitigate that. We have not taken additional price since January, where we only took 1.7%. We've underpriced CPI by almost 900 basis points now in recent years. And we beat restaurant level margin and EBITDA in the quarter and EPS. So we've been able to drive that really strong bottom line profitability without having to raise menu prices.
I'm curious where on the menu you are seeing tariffs hit? Is it something like avocados or, where?
Olive oil?
Yeah.
Olive oil is one. We get our olive oil from Greece, or we do get some of our hormone antibiotic-free beef from Australia. And those tariffs are well advertised on what has been enacted on those countries, as well as potentially basmati rice that we get overseas. But it's been a great rice crop, so that's helped offset some of that. So a lot of puts and takes there, but those are very high-quality specific ingredients we're going to continue to source. Now we do source a lot domestically. We do source the majority of our ingredients domestically, and we are a domestic manufacturer. We have 2 production facilities where we are vertically integrated, and we produce all of our dips and spreads and some of our dressing bases that allows us that efficiency, cost effectiveness, and consistency that we can pass along into savings for our guests.
I'm a red pepper hummus girly myself.
Crazy fat is good, don't miss it.
Yeah. And then speaking about other macro effects, I want to ask about labor as well. Are you guys having trouble finding people to staff the restaurants? What does that flow look like?
Our turnover rates have consistently come down at the team member level for the last few years. So we're seeing, not just the ability to get team members to fill roles, but the ability to get high quality team members to fill those roles. So we haven't seen, any challenges on the labor front.
I was going to say, for pre-opening costs for the year end, you do expect it to be higher. Does that have anything to do with tariffs?
No, we haven't seen any increase in our build-out costs. It's really more directly related to the increase in our unit growth rate. So we raised new unit guidance to 68 to 70 restaurants. Again, reflecting the strength we're seeing in all of these new unit openings and the opportunity we have to bring Mediterranean across the country. So that just adds more pre-opening costs in the total number of units we're building.
And then we wanted to ask too about this hyphen investment.
Yeah.
So we're seeing this trend among fast casual in particular recently. It's sort of maybe automation of parts of the assembly process. So how is this going to work for you? How quickly are you going to put it into action in the restaurants also?
Yeah, we very much believe in human connection. Our mission is to bring heart, health, and humanity to food. So I wouldn't envision Cava being all automation and robots, but we do look at technology and automation to enhance the human experience, not replace it. And so we see a real opportunity on our second digital make line. So we have one in every restaurant dedicated to digital order production. And what we see on that channel is our guests are really looking for convenience, accuracy, and speed. And accuracy is a real opportunity for us, and this is where automation can help our team members deliver on that commitment while freeing up that labor component, being more efficient from a production standpoint, to then reallocate that labor into our dining room, engaging with our guests, engaging in our in-restaurant serving lines. And we look to test a test pilot in the coming quarters, and more to come on that front. But really liked what we saw from the Hyphen team over the last few years that we've been talking to them and looking at the producers of this equipment, and excited to work with them.
Is there anything that maybe Chipotle has done? Because they only introduced into a few restaurants last September. We haven't really heard much about this Hyphen digital make line since. So what are you gauging? What needs to happen for this to work ultimately?
Yeah, for us, we need to see it improve our team members' experience, improve digital order accuracy, and improve the guest experience. When we check all those boxes, it's definitely a win for the business, and that's how we viewed whether it's culinary innovation, equipment innovation, investments in our team to make sure it's giving a return to the guests as well as our shareholders.
Yeah, when you come to pick up that online order, you want it to be there and ready and right.
On time and accurate.
Yeah, exactly.
A full bowl.
Brett, thank you so much. Appreciate it. And Brooke, thank you as well. We got much more markets action coming up, including a check on the markets from the NASDAQ. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Akin live at the NASDAQ, and we're on record watch today after the S&P 500 notched its 16th record close here. We are still trading in the green today, up around 0.3%. NASDAQ Composite, that tech-heavy index, also saw another record, and we are up by the same amount. And then the Dow is up around 0.8%, or right around 330 points here. Now, I want to get to some trending tickers on the Yahoo Finance page because we do have a decent amount of individual movers, and many of those movers stem from earnings. Cava, we were just speaking with the CEO on the program. Shares are down 18%, and this comes after revenue missed expectations. We also saw same-store sales mixed expectations that led them to cut their full year guidance. But on the program, the CEO saying that the company is looking out towards the long term. Although we did say when it comes to the consumer, there is some macroeconomic fog, and that's made the consumer less forward leaning than they were last year. He also talked about tariffs and how that's hitting certain products at the company. That includes olive oil, rice, and beef. So we'll continue to track the outlook for Cava. But again, shares down nearly 20%. We also saw shares of Alibaba on the run today, up around 3% today. And that comes on the heels of these rate cut expectations. Markets are pricing in nearly 100% certainty that the Fed will cut interest rates in September. That's leading to Chinese companies like Baba, along with JD.com, to move higher today. Tencent also reported solid earnings. That's helping to lift the overall mood here. And I also want to take a look at Coreweave. And this is another earnings story. Intraday, we are down about 14%. And this comes after the company reported a wider loss than expected. This is a company that's not profitable. It's not expected to be profitable until late 2026. However, it's really benefited from the AI boom. And if we take a look, roughly since its IPO, we are up over 100% over the past 3 months, even with the losses today. So a lot of folks on the street were saying that maybe we were due for a bit of a downtick when it comes to this name. And then we're also tracking Bullish. This is a company that priced its IPO at $37 a share. It's a crypto exchange that values it at $5 billion ahead of this market debut. So we're going to continue to track where that stock opens and how it trades throughout this session, especially as we know Bitcoin prices continue to rip higher. Ether prices also on the run here. And there's just a lot of tailwind for the crypto space at large. And that's touching a lot of these companies that have any type of crypto exposure here. So keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the trading session.
Now time for some of today's trending tickers. We are watching Amazon, Webtoons, and Hanesbrands. First up, Amazon now offering same-day grocery delivery in more than 1,000 cities. It plans to bring the service to over 2,300 more by the end of the year. The announcement hitting shares of grocery stocks, including traditional stores like Kroger, and also startups in the space like Instacart. Next up, Webtoon shares are soaring after the company announced a deal with Walt Disney to bring about 100 series to its English language app. Now, Webtoon lets creators and users make and discover digital comics. The firm also forecasts revenue for the third quarter that beat the average analyst estimate. And finally, Gildan confirming its $2 billion deal for Hanesbrands. Montreal-based Gildan will buy the U.S. clothing brand for about $2.2 billion in cash and stock as it aims to double its annual sales. Gildan's a global player in the cheap clothing trade that churns out t-shirts and socks for the likes of Walmart and Nike, and also under its own clothing brands like American Apparel. The transaction expected to close before the end of the first quarter next year. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. IBM and Google claim they'll have full-scale quantum computing systems in the next 5 years, thanks to major breakthroughs. It's an acceleration from other timelines. For example, Amazon says it could take up to 30 years before quantum machines are useful on a broader scale. Quantum computers, which utilize quantum mechanics to solve complex equations, are in use today, though adoption is limited. The promising tech has drawn investor attention and then some in recent months. And D-Wave, which develops and delivers quantum computing systems, is one such company. The stock, it's up more than 1,800% over the past year. Joining me now to discuss, Alan Baratz, who is D-Wave's CEO. Thanks for being here.
Thank you for having me.
So obviously there has been this huge upsurge in interest in and knowledge about quantum, although I think we're all still learning quite a bit about it. What do you think of all of these sort of competing timelines, especially when you guys are already making these machines?
Making them, and we have customers using them today as part of their business operation, so we're truly commercial. There are a number of different approaches to developing quantum computers. Some of them will take longer to mature, some of them nearer term. At D-Wave, we provide what's called annealing quantum computers, and those are commercial today with companies like NTT Docomo or Ford Otosan or Pattison Food Group, all using us today to help benefit their businesses.
So for people who are interested in investing in something like quantum computing, what is the use case today for the computers that you're selling versus the next step and the step after that and the step after that?
So I think about it in three phases: near term, medium term, long term. In the near term, there are a broad array of problems that we typically think of as business optimization problems. This can be anything from workforce scheduling to manufacturing plant floor optimization, even protein folding. And these problems can be addressed today with D-Wave's annealing quantum computers. And so the companies that I mentioned a minute ago are all using us for business optimization. In the medium term, I think that quantum is going to make a significant impact on AI and machine learning. Specifically, quantum computers are very fast and very energy efficient. And what this means is that all this rhetoric around AI requiring nuclear power plants and massive energy generation stations is likely not going to be required to anywhere near that level once quantum computers are a part of the training process.
But when is that?
I think that we may be able to get there within a year or two.
Really?
This is medium term. We're not talking about long term. In fact, at D-Wave, we announced a few days ago a first step toward this by introducing an AI machine learning platform that developers can use to start investigating how to use quantum for large language model training. But we still have a ways to go on developing that technology and bringing a complete product to market. And then longer term, we're talking about almost unimaginable things like designer drugs, where we could develop a drug that would address just your specific set of ailments.
So, for people who are investing in stocks like yours and others, obviously you've seen crazy gains in the stock that are exponential. What do you think is still sort of the biggest misconception, or what kind of education do you have to do for investors and potential investors?
Well, there are quite a few different quantum computing companies that are pursuing different approaches to developing their systems. And so I think you really need to take a look at which of these companies are talking about delivering products 5 or 10 years from now, and which of them are delivering products in the near term. I'm very proud of the fact that we are delivering products today that are creating value. And so I think that that's a really good place to start. But there is huge long-term opportunity as well.
And I should mention the opportunity today. You guys have been growing a lot, but you're still relatively small in terms of the revenue that you bring through the door. And so how quickly do you expect that to ramp up? At some point, is there sort of a tipping point?
Yeah. So there are two components to our business model. One is a service-based component, what we call quantum compute as a service. And for commercial companies that really just care about leveraging quantum to get better solutions to their applications, quantum compute as a service is the ideal model. But it takes time to build a revenue base around that because it's a service-based business. It's a recurring revenue business. Goodness, more predictable revenue growth in the long term, but it takes time to build that base of revenue. We also sell systems. Now, we just started selling systems only about 6 months ago. We sold our first system to the Jülich Supercomputing Center in Germany. That is a very complementary model because it's to supercomputing centers, government labs, so not necessarily commercial.
Research-based.
More research-based, but it's near-term revenue recognition. As soon as we install and deliver the system, we recognize revenue up front. So I think the two will work together very well to allow us to build both near-term revenue more rapidly as well as that base of longer-term recurring revenue.
Now, I know you guys have, you haven't made a lot of acquisitions, but you're thinking about how you want to make acquisitions. I don't know if that's the right way to put it, but where are you kind of in that process, and what would be complementary for you guys?
So over the course of the last 6 months, we were fortunate enough to be able to raise a fair amount of cash through at the market transactions, and we thank all our shareholders, and we work every day to try to make them proud of D-Wave and comfortable with their investment. But we now have over $800 million in the bank, and that's well more than we need to achieve profitability, we believe, based on our normal course of business. So we are now looking at trying to accelerate growth through acquisitions. We haven't talked about what the acquisition strategy is. We've been working on it for the last few months. I hope to be able to announce something in the near future, but we're very excited to now have the opportunity to pursue that.
All right, well, obviously we'll stay in touch on that. And lastly, I wanted to sort of zoom back out, and I'm curious about the competition between the US and China. We've obviously seen it in AI. How is that playing out in quantum computing? And is there a risk that we see, them outpacing us as they have tried to do in some other technologies?
There's absolutely a risk. So China is by far investing more in quantum than any other country. They're leading at about 17 billion. If we take Europe, the EU, all of those countries together, it's about 11 billion, and the US is at about 5 billion. So we are behind China significantly. In fact, all the countries in the world are well behind China. So I do think it's important for the US to really start focusing on a better strategy for quantum and really to up that investment.
Have you heard any glimmers of that from Washington? There's obviously been a lot of focus on AI there, but what about quantum?
Yeah, I mean, look, the premier funding mechanism for quantum in the US is called the National Quantum Initiative, and that was put into place under the initial Trump administration. It was supposed to be renewed under Biden. It never got renewed. It still hasn't been renewed. So we really need to get focused on getting that renewed, getting the right programs in place, and making sure that the US is the leader in quantum computing.
Alan, thanks so much
My
for being
pleasure.
here. Really appreciate it. Coming up, we got much more markets action. Stay tuned. You're watching Market Catalyst.
Well, with summer spending winding down and back-to-school shopping underway, it's a good time to check in on the retail investment landscape. For perspective, we're joined by Naveen Jaggi, President of Retail Advisory Services at JLL, which just released its Q2 retail market report. Naveen, welcome. So retail investment volumes, they were up 23% in the first half of the year compared to 2024. What's driving a lot of that resilience, and do you expect that momentum to carry through into the end of 2025?
The U.S. consumer continues to amaze me. They find ways to spend money. In spite of all the tariff talk and the varying things going on in the economy, they keep finding a way to spend money. Now they're shifting their spend quite a bit. They're looking for the longest spend on their dollar, so they'll go to places like Walmart as opposed to maybe going to a higher-end Macy's department store, for example. But they're still getting the biggest bang for their dollar. They're spending money, and that's what we want to see. That for them, they still feel like their jobs are pretty fair, pretty safe, their wages are pretty safe, and as a result, they'll find a way to continue to spend. That's a good sign.
So you hinted at some of that trading down, and we have seen deep discounts, consumers really jumping on to take advantage of some of those opportunities. Is that a sign that consumer demand is healthy, or maybe a warning that shoppers are only going to spend when prices drop?
I think there's a little bit of concern now. We've certainly seen that the labor market's gotten soft. We saw the job adjustment reports from about 2 weeks ago. That tells me that the consumer's feeling a little bit of a pinch on the labor side. So if they're going to be feeling a pinch on the labor side, they're going to start thinking about where they can get their dollar spend more. So whether it's TJX, Marshalls, Ross, Dress for Less, Dollar General, the value retailer, we've known now since the great financial crisis the consumer will spend at the value sector more than they will at the other sectors. I think this is a continuation of that. Don't be surprised by that. Actually, that's pretty common nowadays. Even in the upper household incomes, they will go spend at the dollar stores when it makes sense for them. That will be a continuation of the U.S. economy for me.
So I'm curious, when you do these reports, how closely correlated is the strength of the consumer to the labor market? When the labor market is struggling, do you see that in your results?
Absolutely. So the consumer will tell us that they're going to pull back a little bit here and there. Here's what they're doing. They're saying that for back to school and holiday shopping, they'll spend. But they're spending on essentials. They're not buying discretionary dollar spend. They're buying the essentials for school needs. So that continues on. So I don't look at back to school as a barometer for how healthy the economy is, nor do I look at how sales are at Christmas time. I look at the sales in between those gaps and see how consumers are spending. And so to me, I'm going to watch September and October sales and see how those trend versus last year. And to me, with all of the retailers pushing their inventories forward to get you to spend the money sooner, I think that's going to be the big tell. Will consumers spend money in September and October to avoid the tariff impact for the product that's coming in October and November? Watch that, and that'll tell us how holiday sales will go.
Has that been a trend in the past that they're spending earlier, or do you think that's solely due to tariffs?
I think I'm watching it more closely. In the past, we saw the holiday sales moving up to early November, late October. Now we're seeing more promotions and more talks about retailers spending their sales marketing monies on September. To me, that tells me that they've got the product in before the tariffs came in, and that's going to push that product onto the shelves for a sooner and a quicker sale. Try to capture that consumer for a one-stop shop for all their products.
And what about brick and mortar? Your report showed that store openings outpaced closures in the first half of the year. How's the brick and mortar business?
Brick and mortar is fantastic. Look, for all the talk of online sales being 22% of total retail sales, that tells me that 80% of all retail sales in America today take place at the store. That's a pretty good story, considering all we've heard about for the last few years is that consumers continue to buy online. They may be influenced by buying online. They still like to go to the store and shop, especially things like groceries.
Yeah, I was going to say, does it depend on the product when it comes to whether you're going online or in store?
Yeah, they want groceries, for example. We thought back in the pandemic that people would never go back to the grocery store. There was an estimation that people would stop shopping at the store and buy online. That did not happen. As soon as the barriers came down, you get back to shopping, you started going back to the store. So grocery stores, at one time, 3% of total grocery stores were online. Now it's like 6%. So it may have doubled, but it's still a small portion of the overall sales for groceries.
And have you seen companies like Amazon, for example, take some of that market share away from some of the smaller players when it comes to online shopping?
You cannot ignore Amazon. $24 billion in sales for Amazon Prime for 4 days. They doubled their numbers, and they went from 2-day sales to 4-day sales. They did more business on those 4 days than we do on Black Fridays. That gets to tell you Amazon is an absolute monster in the business. Can't ignore them, accept them.
And you were just mentioning the trade developments, how consumers are weathering tariffs. How about on the retail side? How are retailers battling this? And we have heard during this past earnings season that they're actually absorbing a lot of those costs right now.
They are. I think most retailers recognize that the tariff environment we're in is not something that's sustainable in long term. It's a political negotiation play. So as a result, retailers will say, we don't want to scare the consumer off and make prices to the point where they're sensitive to price increases, so we'll absorb them. So we may see some hits on the bottom line by retailers, but that's short term. Most every retailer I speak to thinks that the market will be different, much different from a tariff environment next year, so they're willing to hold on to those prices and not push those to the consumer aggressively.
Do you think there's a point when retailers aren't going to be able to do that and they're going to hit a point where they have to pass on some of these costs?
Absolutely. I mean, if you look at the stuff that's being made in India, right? So we just saw recently that Brazil and India were two countries that got pretty significant tariff hikes. If those things don't subside by the fall and winter, those prices will be passed on to the consumer. So to me, I'm watching Q1 and Q2, watching the news. If those countries come to the table and negotiate well, you'll have a good story. But if we don't see those negotiations go well for the consumer or for the retailer, prices will go up, and that will have a lag on consumer confidence.
And you were just saying how you speak with retailers pretty consistently. What else are you hearing? What are the takeaways from you about this really volatile environment where it is hard to plan for the future?
Think long term. They're not going to react in the moment. They know consumers, for the most part, are a bit confused about the environment right now. They're saying, wait a minute, are tariffs going up? Which countries' tariffs are going up? They don't know exactly what product will be impacted. So in that environment, the general consensus is, let's not shock the consumer with too much price increases. And the consumer, by the way, is pretty darn resilient, as we've said over and over again. Last piece to remember, about 20% of the top household income earners in America represent about 50% of all consumer spend. They're the ones doing great. Like the 401s are doing great, the 403s are doing great, the markets are up, almost every major indices is either up or at near-time highs. They're doing well. As long as that top 20% continues to spend money, the overall landscape looks pretty darn good. Now, long term, you're worried about the wobbly labor environment, that could impact that middle market consumer that's saying, wait a minute, if you look at Chipotle and you look at Cava, and those things are higher priced items, will they start moving back to KFC? Will they start moving back to McDonald's? Will they start moving back to something a little more affordable? That's what I think we need to be watching in the Q3, Q4, Q1 26 environment.
And to that point, we just got Cava earnings. The stock's off around 20% right now because they are struggling now. You bring up a good point about the bifurcation of the U.S. consumer. Higher income, doing well.
Doing great.
Middle, lower are starting to struggle a bit. How have you seen that reflected in some of the data that you guys do, who you talk to, and what's the concern longer term if we continue to see that bifurcation?
So I think my biggest concern is that the U.S. consumer, if they feel like the environment is not in their favor, right? So what we heard was that the market should be in their favor, that the president's going to make laws and policies to benefit middle America. If those don't develop in 26 and they start showing some sense of lack of confidence in that environment, you're going to see the consumers start to pull back because the jobs aren't there like they were supposed to be there or they were promised to be there. If you put that doubt in the consumer's mind, that's when you see the retailers start to worry about their plans for 26 and 27.
Treasury Secretary Scott Bessent saying that sanctions on Russian oil could go up depending on the outcome of Friday's meeting between President Trump and Russian President Vladimir Putin. Bessent's comments coming as the International Energy Agency expects world oil supply will rise quicker than expected amid an increase in output by OPEC Plus and others. Joining me now, Dan Dicker, the Energy Word founder, to talk through all of this. Dan, it's great to see you.
Hi, Julie. Long time. How are you?
Long time. I'm doing well. How are you doing?
Okay, just well,
Good.
thanks.
So let's talk first of all about this IEA forecast here, because their forecast is that oil inventories will be nearly 3 million barrels a day. And we saw oil prices kind of pull back on that. So how sustained, when we see forecasts like that, how sustained do we tend to see that effect in the market?
Yeah, in a lot of ways, I think that they are catching up to what the analysts, including me, I believe about the fundamental nature of oil supply, and that is it's very well supplied. OPEC has sort of given up on trying to control price through supply. The last two meetings have not yielded any decreases in production. In fact, there have been minor increases in production. Here in the United States, there's nothing but supply that's being shut down based on price. In all ways, I think the IEA is just catching up to what the fundamentals kind of say, and that's oil is pretty flatlined, as it's been from, since the summer of 2024.
And do you think that these dynamics in the oil market, in terms of the supply demand dynamics, it's not just a 2025 situation? Do you think it's goes into 2026 roughly the same?
Yeah, I never say never, because when you do that, you always get stuck, and oil will always surprise. And there's a moment at which, enough supply will shut down where you will get a rally in prices, but I don't see that in the short term. And in fact, for my subscribers, in energy, we've been pointed towards, other markets, particularly natural gas, and mostly some of the commodity stocks that surround the renewables to find any kind of value or good beta, decent, return, decent volatility that's going to give you a decent alpha, some return here, because while tech is, the main driver of the stock market, there's very little in the energy space that is doing as well, but some of those are in the renewable space and not in traditional energy, fossil fuels.
Dan, I also want to ask you about these talks expected between Trump and Putin. What is the oil market watching most closely in terms of how it could affect supply?
I'm afraid we've gone through this rigmarole with Trump and Putin and sanctions and Russia too many times to take it very seriously. I don't expect much to come out of these peace talks. I don't think much is going to come in the way of sanctions. I think Trump has more of a feeling of threatening Russia with sanctions as opposed to really applying them seriously. And so from an investor standpoint, we're really kind of focusing on the fundamentals and trying to stay away from the political, at least on that side. In the renewable space, it's a lot more difficult with tariffs and the trade negotiations with China, for example, that seem to muck up, the runway for a lot of the solar stocks, for example. So, there's a lot of political action going on in the energy space that never used to be, something we used to take into account. But in terms of traditional fossil fuels, it's mostly still the fundamentals that we're working with.
Well, and just quickly, in terms of the negotiations around all of that, India has been buying Russian oil. That's something that Trump doesn't like. He put the tariff on India partially as a result. But if India stopped buying that Russian oil, what kind of effect would that have on the market? Would that stop up some of the supply out there?
It certainly would, but it's not something that I would expect. I mean, this kind of flow of Russian oil to the east, to China and to India is not something that actually I think is going to stop but increase in terms of, where the Russians get their marketplace, sanctions or not. So this is not something I think that Trump can put enough pressure on to stop India. They have a tremendous appetite for oil. They have historically bought it at the cheapest places. And right now, that's the Russian supply and in some ways the Iranian supply too, and that's what they'll go no matter what Trump threatens them with, I believe.
Dan, finally, I wanted to zero in on a specific stock, and that stock is Venture Global. It was an IPO that has been underperforming, especially given some of the other hot IPOs we've seen this year. It's an exporter of liquefied natural gas from the U.S., but the stock is going up today because it won an arbitration case against Shell. But I'm just curious what you think of that company and why, it's been under such pressure since LNG's been in pretty high demand.
Yeah, LNG's been great. The problem is always finding the long-term contracts. And in that case, Cheniere is so far ahead of everybody else in terms of that runway that's the LNG stock that I've been recommending to subscribers. It's now 6 years going on, and it's been a big winner for us. So the next great LNG company that's going to be able to find those contracts and get a foothold in the LNG space, both to the east and also to Europe, is going to be a winner. So I think there's a little bit of fishing going on from the speculators here, trying to find a value in one of these LNG players. VG seems to be one of those right now. It's pretty darn cheap, but that doesn't mean that, I think it's wouldn't be number one on my list in terms of a speculative play in LNG. And I would stick with Cheniere because they have all the contracts, and their profitability on LNG is almost guaranteed for the next 5 years.
Yeah, I was just looking at that five-year chart for LNG, and it has been kind of a rocket ship there. What am I looking at? Up 327%.
Thank you very much. I don't get them often, but once in a while.
Yeah, when it hits, it hits. Dan, thanks so much. It's good to see you. Appreciate it.
Thanks, Julie.
Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, U.S. stocks hitting record highs as investors price in rate cuts. Will we indeed see a cut in September? We'll discuss. Plus, the White House reportedly expanding its search for the next Fed chair, although the White House pushed back against that idea. We're going to break down who is likely to take over for Jerome Powell. And Coreweave's rally comes to a halt as investors turn cautious on its massive data center build-out. All that and more coming up on Market Catalyst. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here and where we are seeing the trade. Not seeing a huge gain for the S&P 500 on the back of yesterday's record close, coming down off the early highs of the session, but still hanging on to a gain, as is the NASDAQ of about 1/5 of 1%. The Dow leading gains, as it has been all session long, up more than 250 points, about 1/2 of 1%. Well, the Consumer Price Index for July showed prices rose 3.1% year over year, excluding those volatile food and energy prices. And while that wasn't as steep as some feared, it will factor in, of course, to the Federal Reserve's decision on interest rates next month. Joining me is Jason Furman, Harvard University professor. Jason also served, of course, as Council of Economic Advisors chairman under President Obama. Jason, it's good to see you.
Good to be with you.
So this debate over what's going to happen in September is really fascinating because on the one hand, the markets say it's a sure thing, right? We're getting a cut in September, but people and economists we're talking to are saying not so fast. So what do you think?
Look, it's still a tough call because inflation, it may come in below what it was expected, but it came in well above what we were hoping for if you think about the beginning of this year. We're headed towards 3% inflation. The job market is slowing, but a lot of that slowdown is the structural break-even job growth is slowing. When you have less immigrants, you just can't create as many jobs regardless of what the Fed does. So their move isn't obvious. I favor a cut based on the information that we have to date, but we have more inflation and more jobs data before they need to lock in a decision.
As you say, inflation is higher than we had hoped for, right? But you posted a chart yesterday looking at the mean CPI inflation, looking at the 3-month change, and it has moderated, right? It definitely has come down. So what are you finding, I guess, alarming or concerning in the read yesterday, for example?
Yeah, so the median inflation, which is what you have on the screen, is a good way to take out some of the outliers. And partly what happened in July with some extreme price increases in certain sectors really drove the numbers. But what you're showing on that screen there also shows inflation that never really landed. We thought we'd be coming down to 2% inflation measured on a PCE basis. That would be a bit higher using median CPI, and it just hasn't landed. And maybe that landing would have happened without the tariffs. Maybe the tariffs are transitory. Inflation expectations so far look pretty good. But when you've been on the wrong side of your target for nearly 5 straight years, you need to start worrying about that.
Or do you change the target?
I've been in favor of being open to raising the target in the past. I'm a little bit more skeptical about it now, because neutral interest rates actually are quite a lot higher than I had thought, and that was a big reason why you wanted a higher target. Regardless, you don't want to change the target midstream. You could change it as part of the Fed's next review, be really transparent about it, but don't do it in the middle, and certainly don't do it with the inflation rate above 3. You want to, if you shift the target, make a hawkish pivot to a new target.
Jason, as somebody who is an economist and has also worked in government, I'm curious, if the Fed does not cut in September, do you think that raises the likelihood that the president once again leans into this idea of removing Jay Powell because of the Fed building renovation, or he recently threatened to sue him in some way? I mean, do you think we see an uptick in that kind of rhetoric if there's no cut?
I think we'd certainly see an uptick in that type of rhetoric. Firing him would be completely irrational. It's 1 out of 12 votes on the FOMC. His term as chair ends in May of next year anyway. And the rational thing to do here, not what I'd recommend to a president that I worked for, but the rational thing to do is to just set up Jay Powell to take the blame. We're seeing slowing economic growth. We're seeing rising inflation. I think that has everything to do with tariffs and immigration and almost nothing to do with the Fed. But if I were President Trump, I sort of get why he would want somebody else to blame. But in order to blame them, he needs them to actually be there and not to fire them.
Well, that is definitely an answer from your political hat wearing, not your economist hat wearing, correct. Jason. I want to switch gears and ask you, speaking about a firing that some think was irrational. We have, of course, the removal of the top person at the BLS and the nomination of E.J. Antoni to take his place. Earlier this week, I talked to former Fed economist Claudia Sahm about Antoni, and I want to play for you what she had to say.
My biggest concern is the BLS is facing a lot of challenges. It is legitimately hard to run surveys, construct statistics, communicate them to the public, get them out in a timely manner. And frankly, this nominee just doesn't have a lot of experience and background in measurement and statistics.
Jason, I know you have also expressed some concern about Antoni as the nominee. I mean, if he takes over, what's the sort of worst case scenario? What's the best case scenario?
The best case scenario is that he does nothing, that you don't have the type of leadership and input that would help the statistics improve, but they don't get much worse. The medium case is that you suspend some data, you stop producing the micro data, maybe you try to make some radical changes to the revision process that even if they're not politically biased, end up breaking it because you don't understand the machine, you can break it. And then the very worst case scenario is he starts pushing and nudging the data in the direction he wants. I mean, that worst case is quite unlikely. There's a lot of protections in place, but I can't tell you there's no chance it would happen.
Do you think that that he will get Senate confirmation? Is there a chance that he won't?
I don't know what the vote count looks like in the Senate, but I can say I don't know why someone would vote to confirm someone with absolutely no background or track record in the agency he's supposed to lead. This is somebody who both the Wall Street Journal editorial and the National Review and just about every conservative think tank in DC have raised very, very serious questions about. I haven't seen answers to any of those questions.
And Jason, while we're talking about changing personnel, I do want to ask you about the replacement for Jay Powell as well. CNBC reporting this morning that there's an expanded list of candidates now. It's not just the Kevins and the Chris in terms of Hassett, Warsh, and Waller. Do you have one that you think would be more qualified than the others or more reassuring to the market, to put another way?
Yeah, I think most of the people on the expanded list would do a perfectly good job at the Fed. There's 3 things you look for. One is, do you have enough knowledge and expertise? Number 2, you might care about where someone is on a hawk-dove spectrum. But number 3, and far and away the most important to me, is do you believe the Fed will be independent and will you act to safeguard and protect that independence. That to me is the non-negotiable trait I'm looking for in a Fed chair. And I think many, but not necessarily everyone on that list, am I convinced, has that trait.
Right. Some of them get better scores on that than others. Jason, thank you so much. Good to see you.
Good to see you.
We got much more markets action coming up. You're watching Market Catalysts. Coreweave shares are sinking as widening losses in its second quarter overshadow AI demand growth. The data center company reporting a net loss of about $290 million, operating expenses ballooning to $1.2 billion. They were only $318 million the year prior. Joining me now on this, Paul Meeks, Managing Director of Freedom Capital Markets. Good to see you, Paul. So as we see what's going on with Coreweave here, there has been all through this earnings season the weighing of sort of the spend versus the demand. Why is Coreweave getting punished like this when others who are spending a lot are not?
So first of all, let me break some news for you. I understand, Julie, that you are being considered for Fed chair. So
I'm on the long list, Paul. You're probably on there too.
So as it pertains to Coreweave, now remember, Coreweave started this month at a low of $102 per share. Before the print, it had closed at $149 per share. So maybe some comeuppance was in store. But even though the company has voracious demand and their revenues reported were better than expected and their guidance better than expected, the problem is they did not answer the question that the bears have been asking for some time. Is this company ever going to make any dough? Now, I was around during the deflation of the internet bubble, and we used to call some of these companies profitless prosperity. And that means you have great revenue, but you never bring it through to cash flow and earnings. I think Coreweave is going to be just fine in the end, but the problem is I don't think you will see evidence that this is not a profitless prosperity company until they break even, and it won't be this year. It's probably sometime late next year.
Well, and remember the IPO was earlier this year at $40. It's trading at multiples of that. Right. And so the bump that we're seeing today, does it sort of drift lower from here, or do you see people piling back in on the hopes that it will eventually turn that profit?
I think it'll turn around, but this is what I think happens. I think it could easily retest that 102, 103, 104 low base. And we weren't there that long ago. That was just the last couple of trading days of last month, the first couple of trading days of this month. So I own the stock as a privately held company. So I'm in at a outrageously low cost basis. But even for a new client that wanted to be in this stock, I'd wait to see if we get to around that $100 handle before I start to buy back the shares.
Gotcha. Lucky you, by the way. And is there anything that is doing a similar thing to Coreweave, but doing it better that investors might want to look at?
I still think Coreweave is the number one in the space. Nebius, which is essentially its counterpart in Europe, could be interesting. But I still would probably go with the hyperscalers that have free cash flow and profits. And even some of these semiconductor companies, a la AMD and NVIDIA, even though they have vaulted upward with their stock prices, probably over Coreweave. But my favorite pick in all of tech continues to be AppLovin.
AppLovin. All right. Well, we're going to dig into that a bit more another time, because I want to move on, broaden out this discussion in AI. Paul, you're going to stick with me, and we're going to talk about Perplexity here, because Perplexity is making a bid to acquire Google's Chrome browser for $34.5 billion. That's at least according to reports out there. The AI startup only worth about $18 billion, according to its latest funding round. So some of the funds would have to come from outside investors. It was an unsolicited offer, and it comes ahead of U.S. antitrust proceedings that could force Alphabet to sell the web browser. It seems like most of the street is not seeing this as terribly realistic, but want to talk about sort of how this fits into the broader AI landscape. Adam Kovakovich is with us now as well, Chamber of Progress CEO and founder. Paul Meeks of Freedom Capital Markets is still with me as well. And Adam, as we look at the AI landscape here, Perplexity is not as much of a household name within AI. Is this just a marketing move on its part?
Yeah, I think their hottest product is publicity. I think these offers keep Wall Street buzzing without them having to spend a dime. 1 week we hear that the big tech wants to buy Perplexity. The next week they're kind of swaggering in as a potential buyer. Back in March they said they were putting in a bid to buy TikTok. TikTok wasn't for sale. I think the press clip is the point, right? As you noted, the value of Chrome is double or more than Perplexity's own value. When the check would be bigger than the balance sheet, I think you're selling headlines, not buying browsers. But look, I think founders know that swagger can kind of goose valuations. Getting their name uttered in the same breath as Chrome kind of signals big league, right? It sets a higher price for if someone tries to scoop you up. And let's face it, it kind of worked. We're here talking about Perplexity, aren't we? Right? So unfortunately for them, it's not about how valuable their core product is.
But Paul, when you look at the Chrome situation, the Alphabet situation, do you think that they are going to be forced to spin off Chrome? I mean, we've talked to some analysts who say even if they do, it's not necessarily a bad thing for Alphabet.
I agree that it won't necessarily be a bad thing, but I think when you get to the end of the day, I don't think that the feds are going to force the divestiture. So this deal or proposed deal by Perplexity AI so premature. The other thing that's going on with Perplexity AI, though I do think Perplexity AI is a real deal company, is it's rumored that they may sell themselves to Apple. And so you want to crank up the PR machine to drive up your valuation so Apple takes you at a bigger price. So I think that might also be at play here.
Right, that's sort of what Adam was referring to as well, all part of the same hype machine, if you will. But guys, at base here, we're talking about which LLM model is the best, right? Perplexity, as we said, doesn't have as high a profile. We just had OpenAI come out with GPT-5, and there were some critics out there of how well it was working. Adam, I want to take this to you. Like, which is going to be the winning LLM model? Everybody is obviously throwing a lot of money at various models and platforms. And what determines who's going to win in the end as well?
Well, we don't know. I think, and that's great. I think it's great that we don't know because the fact is we have this intense competition between models, and that's exactly what you want to see. I think in some ways, some of the most recent economic data shows that we kind of have a little bit of a split screen economy right now, right? We've got AI as the engine kind of pulling the economy, and consumer spending on AI growing faster than all consumer outlays, right? Data centers, GPUs, all of that, right? Roughly 60% of the S&P 500 gains came from the AI six-pack, right? Microsoft, NVIDIA, Meta, Amazon, Google, Apple. And so you take away that surge, and the economy wouldn't be looking as strong as it is. So I think it's great that we have all this competition between so many companies, and the fact that that is the case shows that competition is alive and well here.
And what about you, Paul? What do you think?
Well, I think over time, it won't be a binary decision. I think there'll be a couple of major successful LLMs, but I don't know if it'll have a dominant share, but I do expect ChatGPT to have the leading share. If OpenAI was to go public today at its most recent private valuation round of $500 billion, it would already be one of the top companies by market cap in the S&P 500. So they have that heft, they have that interest, and of course they also have a sometimes good, sometimes bad relationship with Microsoft. So when you have those two behemoths, I think that they will stay ahead of the game.
Adam, Paul, thanks a lot. Good to see you.
Thank you.
Thank you.
Coming up, we'll get another check on the markets from the NASDAQ and get you caught up with some trending tickers.
The NASDAQ and S&P 500 are smashing records almost every day. And on today's Stocks in Translation, we are asking a simple question. What is driving the biggest stocks right now? Is it earnings or valuation? We need to begin with a few definitions that deal with stock fundamentals. These are derived from financials that Wall Street analyzes. So just stick with me because in a minute, I'm going to tell you how each of these concepts relate to each other. First, we have forward earnings per share, or forward EPS, which is just the street's best guess of profits for each share of the company over the next 12 months. When the outlook improves, it rises. When Wall Street cuts its estimates of future profits, it falls. Next up, we have the forward PE, or price to earnings ratio. It is the stock price divided by that forward EPS that we just talked about, and it tells you how many dollars investors are willing to pay for $1 of expected profit. When the multiple rises, that's called multiple expansion. And when it falls, that's called multiple compression. Here's how they fit together. Share price equals forward PE times forward EPS. And here's an example. A $10 stock with $2 of forward EPS trades at a 5 times forward PE. The $10 stock price equals the 5x multiple times the $2 forward EPS, and that right there is a whole engine. Now let's see it in the wild with NVIDIA. This chart goes back a decade and it shows the NVIDIA stock price in white and its forward earnings per share in green. You can see how they more or less have tracked each other over the long term. The stock price and profit expectations are closely linked over these time frames. Right now, at the right edge of the chart, price is pressing to new highs. Meanwhile, forward EPS is also near its highs. That means fundamentals are broadly supportive, and the extra gap that the market is paying, that's a multiple or a re-rating, as we say. Now, Amazon, it tells a different story. Through 2023, price and forward EPS, they were climbing nicely together. Then in 2024, forward EPS dropped sharply, and you can see that toward the right of the chart. As that green line fell, the stock still pushed to fresh records, but that was a re-rating thanks to that multiple increasing. Lately, it has struggled to clear that old price peak, and without a turn higher in profit estimates, that price rally is harder to sustain. So what's driving the big five? We put forward EPS change on the vertical axis here and forward PE change on the horizontal, all in a grid. In the top left, both of our variables are up. Profits are rising and investors are paying a little bit more. And at the top right, this is when upgrades leave. Expected profits are rising while the multiple cools. Bottom left, that is a re-rating. Expected profits are down, but investors are expected to pay more. And finally, in the bottom right, that is a de-rating. We see both expected profits and the multiple are under pressure. So let's take a look at how these concepts are playing out in the 5 biggest stocks in the S&P 500. Here at the top are the first 3. We see that NVIDIA is currently in a re-rating. The multiple jumped while forward EPS, it slipped a touch. Our 2 levers for Microsoft and Apple are both up, with modest estimate improvement and a smaller multiple lift for each. Now, here are the other 2 stocks. Alphabet has both of its levers moving up, but the multiple is doing most of the work. This is a heavier re-rating. But Amazon is in the worst position of the group, caught in a de-rating cycle. Profit estimates have been heading down, as we saw in the chart a minute ago. And also, Amazon's multiple, it's cooled. It needs stabilization in forward EPS to regain its upward momentum. So putting it all together now, here's what to watch next. First, pay attention to the forward EPS trend. Are analysts raising their profit estimates or are they cutting them? Second, the forward PE direction. Is the multiple expanding or is it compressing? Third, how are each of the names migrating around the grid that we showed before? Toward the upgrade lead in the upper left or towards the de-rating in the lower right? These 2 levers, they explain most big stock moves, not only in these stocks, but all equities, at least over the long haul. But it's important to remember that day to day, there are many other factors that will send stocks up or down. Bottom line, long-term price moves come from 2 places, expected profits and what investors are willing to pay for them. The cleanest path for a stock is when profit estimates take the baton from the multiple. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More Market Catalyst is next.
U.S. mortgage rates dropped last week by the most since February. That's according to data from the Mortgage Bankers Association. The rate on the 15-year mortgage fell below 6% for the first time in 4 months, matching its lowest level since October. The news comes as government data showed shelter costs continued to decelerate in July, though they still outpace overall inflation. Joining me now, Danielle Hale, Realtor.com chief economist and Yahoo Finance senior housing reporter Claire Boston. Before we sort of dig into the shelter costs broadly, Claire, I do want to start with you just on this Mortgage Bankers, the latest rate news that it is coming down. I imagine this is welcome news for folks who are trying to move, since we have seen those rates so persistently high.
Yeah, Julie, anything really helps here since we've pretty much been stuck at this kind of high 6% space for pretty much all of this year. That being said, when I'm looking at this MBA application data, what sticks out to me is that we have not really seen an uptick in purchases yet. So, that suggests to me, people who are sitting on the sidelines are not jumping back in with rates a little bit lower. We are seeing refis tick up quite a bit though. So, maybe if you have a 7% or higher mortgage rate, getting a little bit of a drop here is going to entice you to refi, but we'll see kind of what happens in the coming weeks.
Yes, we will. And what we'll see in the coming CPI reports as well, because really shelter has been sticky, as economists like to call it. Those shelter costs, even if they're moderating, they've just been sort of persistent here. Claire, what do we see in the numbers for last month?
Definitely. So we are still seeing shelter inflation run quite a bit hotter than general inflation. It is coming down. This is kind of the lowest year-over-year print since, I believe, October of 2021. That being said, housing costs are still rising. And, I think that we talk a lot about affordability. A lot of both renters and potential buyers are still feeling stretched. And, their incomes may not be keeping up right now with their housing costs.
So Danielle, let's bring you into this. Why has this been happening? Why are these costs? Why is that shelter inflation so sticky and so persistent?
Well, we had a huge run up in prices during the pandemic, especially in rents, which really soared. They've softened recently, at least on the asking rent side of things. But if you look at rents more broadly across the economy, so for renters who might be staying in place and renewing, they are in many cases still playing catch up to those significant increases that we saw during the pandemic. So that's why shelter inflation costs tend to lag market rents. The good news is that market rents have actually softened again. Our rental report shows that we've had 24 consecutive months of rent softening as of July, and the rents were down 2.7% on a year-over-year basis. So it's a bit of a discount, but again, this is just asking rents. And so what we're seeing in those broader trends when we examine the data for all rental units is not quite as much softness yet, but we do expect to see that on the horizon. Now, one sort of caveat or warning is that with the trade uncertainty that we've seen and the softness that we're seeing in rental data, we're starting to see multifamily construction slow, at least on permits and completions. And so that means that the softness may not last, but it is there. And I do think that's going to help bring inflation down as we look in the months ahead. But then we do have this wild card of tariffs, which could lead to some opposite findings.
Yes, we do. I mean, and in terms of how people feel about it, they definitely feel that things are unaffordable. Claire, we did a Yahoo Finance poll recently that sort of dug into that idea of affordability.
Yeah, I mean, in general, most people are saying that they really feel like the housing market is out of reach for them, at current prices, especially when we look at the purchase side. Home prices, depending on your metro area, are up anywhere from 15 to 50%, from those pre-pandemic levels. And that makes it really difficult to, get into this market. It's not just purchase price. It's also that, that 6.7% mortgage, that really cuts into your buying power right now.
So we've been talking about sort of renting versus owning. Danielle, what's the percentage, I'm curious, of the U.S. that is renting versus owning a home? And what are the relative merits right now, given the cost of each?
Right, so it's roughly 65% to 35%. And we have seen homeownership rates soften because of these high costs that Claire were talking about, not just the purchase price, but also the mortgage rate. And earlier we were talking about mortgage rates coming down. It is good to see this movement lower, but it's worth putting it in context. Being at the lowest in 4 levels still means we're up above 6.5%, and still means we're looking at mortgage rates that are significantly above where they were during the pandemic. So those costs really haven't adjusted. If we look at for younger households, so those are those households that are likely to be most flexible between renting and owning, or on the fence between renting and choosing to buy a home, that's where we've seen homeownership rates slip the most. And that's a signal of just how challenging the for sale market is, and also a sign that we're seeing some relief in the rental market. In June, we took a look at rental costs versus buying costs and found that if you're looking just at the simple monthly cost basis, the majority of the largest metros, all except one actually, were tipped in favor of renting right now. So the short-term financial incentives are very much in favor of renting. But for those who are going to be in their home for a longer time and are thinking over that longer term horizon, it might make more financial sense to buy, but you've really got to invest and be planning to stay put for a longer time in order for that to make financial sense.
And you alluded to tariffs before, Danielle, and whether you're renting or buying, you've got tariffs affecting construction costs, supply costs, et cetera. We've been trying to figure out how tariffs are affecting everything, right? And on what timeline. How should we be thinking about it with housing costs?
Yeah, so it's not something that we're going to see right away. But in our recent rental report, we took a look at the areas where we're seeing the biggest slowdown in multifamily permitting activity. So that's one sign that maybe some of the softness in rents and tariffs in general have affected builders' appetites to continue building multifamily properties, which are typically going to become rental units. And the timeline for that is usually a couple years out. So we found that in some metro areas that usually see a big run up in permitting activity from the first quarter to the second quarter, we actually saw significant declines in rental activity. So that does suggest we are seeing some builders react to market conditions and are seeing some slowing in specific areas. Some of the markets where we saw this is in Philadelphia, as well as Orlando and San Diego.
Claire, Danielle, thank you so much. Lots of interesting info here for those who are trying to figure out their next move. Appreciate it.
Thank you.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.